Today we are discussing, it's a little bit controversial, John, this div or division 296, and it's the proposed tax on superannuation balances that are over $3 million.
Which most people think that's a lot of money.
It is. What's it like to have that much in your super,
I would
John?
not know, but I do hear a lot of people around the country are not happy with it.
Yeah, and that's what I kind of want to get into, because I want to take people through the details, how it works, how it's calculated, a bit of the history of it, has it been tried elsewhere, and we're really just going to, unpack it.
Yeah, I'm going to strap in for the ride. You're going to lead this thing because this is your baby.
That's right. So if you are watching on YouTube, you will see the presentation that I've got. Look, you probably will be able to listen along if you're listening on the podcast app or on Spotify, but we did want to make this visual as well to explain to people. But if we go now, and John, jump in along the way. John Pidgeon, of course, hosts the This Is Property podcast, which is also on YouTube. It's got its own channel. But let's start by saying we are recording this on the 28th of May. I did want to date stamp this episode because this legislation, it's still in play. It's in the Senate at the moment, and it may get amended, it may not, but we just want to say that there could be changes by the time the Senate reconvenes in a few months' time. Right. So I'll just say that. So what is Division 296? Well, it's scheduled to start on the 1st of July this year. So I would imagine the Senate, they're not meeting again before this date, but it'll probably, if it gets passed in its current form, we'll have a baked-in start date of 1st of July 2025.
Yep.
As we said, it applies to individuals with a total super balance, or we'll call it the TSB, of over $3 million. And it means over the $3 million in super, it's effectively a tax rate of 30% on earnings. However, there is a however there. There's some interesting ways that they do calculate that. So the 30% is made up of the 15% internal super tax rate that's already there.
Yep.
And then they're just applying a second 15%, so a total of 30%.
Yeah. So it's an increase, essentially 15% is what you're saying, but collectively it's 30 overall.
Yeah, for those balances in superannuation over $3 million. It applies to all APRA funds, which are your industry funds, your retail funds, self-managed super funds, and exempt public sector schemes. And it's not a cap on superannuation. It's literally an additional tax. So we want to flag that. How much will it generate? So Jim Chalmers, the architect, they're pricing this in at $40 billion over 10 years. And it's important to note, John, that this applies to approximately 0.5% of all superannuation balances in Australia right now.
Which is pretty minor overall, isn't it?
Yeah, and that's why there is that part where maybe we need to have a bit of a cold shower and chill out. But what I want to do is just kind of walk people through the mechanics of it. I want to also get your opinion. And just a reminder, like anything on this podcast, John, it's effectively a big opinion piece of both of us when we've got a microphone. So, but yeah, I was just adjusting some audio levels there. But yeah, so pretty much 80,000 Aussies have super at the moment with over $3 million. It's not indexed at the moment. So in the legislation that's proposed, it stays at $3 million. Forevermore, amen. A couple of things. Chalmers has put these costs. So, if we look at the government budgets, when we did the budget recently, the $40 billion over 10 years saved from this scheme has been spent.
Yeah.
Okay, so it's in play,
Yeah.
and I think it'll just be a matter of formalities when the Senate reconvenes. Jim Chalmers has basically said he has said the indexation, future government will do that. And look, he's probably right. I'm not here to carry water for him. It's no different than other things over time where there's a federal budget each year. If the government continues to be lobby, like it'd be actually very easy for them to increase that. So I don't want to see this with fear or scariness. But
I suppose I haven't had anything like this within super in our time anyway. So it's actually that's maybe one part of it. It's like, well, why are you touching my super? I'm putting it into super because it's a tax haven essentially. Now you're telling me I'm going to get taxed more on it.
Yeah, but you have to look back at the major super reforms in 2007 from the Costello-Howard government. Remember that year when they were changing to the contribution cap limit and removing reasonable benefit limits called RBLs, which was a confusing system. They had a transition period not to impact people negatively, where they allowed $1 million to be put into super on that transition period. So effectively, if you're one of the people that put $1 million into super in 2007, one, you're doing all right. Two, this is probably you if you're still alive.
Yeah.
And three, when we go through the actual numbers here, it's actually not as big and as scary as what it sounds like.
No.
And it won't impact as many people. And 100%, there is that one big elephant in the room. Do you know what that elephant is, John? And it's not me.
No, I don't know what that elephant is. So I think it's essentially taking from the rich to give to the government, to give to everyone else.
Yeah. And it's a broader question with society, right? Like every year when the federal budget happens, we as society demand more from the government. And that money has to come from places. The problem structurally, and I don't want to camp here, but the problem in Australia structurally, too much of the Australian budget is reliant on income tax. So that's just a comment. So the money has to come from somewhere.
Yeah, and there's always the argument that we're paying too many taxes and like you can go for back and forth for years, can't you? Say, well, okay, well, what are we doing with the money? Is it being spent wisely? Like, are we wasting money in different sectors? Like, there's a no-win situation, whatever you impose here, is there? Yeah.
So, look, I just want to say the elephant in the room is the whole notion effectively that as part of the mechanics of this, unrealized gains will be taxed.
Yeah, so
that's the elephant.
I've already got, say, another 500,000 of growth in my share portfolio or my property, as at today's valuation. I'm now getting taxed on that 500,000,
even though you haven't sold it.
It's just on paper as an asset.
Yeah,
yeah, that's hard to swallow.
It really is. And there's a reason why they had to do it that way, and I will tell you as we go along.
All right,
but
I'm
back,
interested.
Back to the cricket. Just a bit of history. Someone did put in the Facebook group, has it been tried around the world, Sweden and Germany? So I just inserted this slide. In the 70s and 80s, Sweden tried it in the 70s, a tax on unrealized gains. It was across pretty much everything. There was a liquidity crunch, and it just created so much complexity. So they basically ditched it.
So it's no longer, it only lasted for a period of time.
Yeah, and Germany in the 80s, there was a tax on unrealized gains. It just was, a nightmare as well. And I guess the difference here in Australia now is that it's targeted to superannuation only at balances over $3 million.
And I suppose...
But it's going to have the same problem with liquidity of assets and values. And you go on because
I was just going to say the administrative issues you wouldn't have thought. The 70s and 80s very different to 2025 where technology means that they can look up anything at a drop of a hat.
Yeah, but this administrative thing, it speaks to why they have to tax unrealized gains. And that's what I'm going to explain to you why they're doing that.
So neither of those are still in today? There's nowhere around the world that's currently got it?
I think they've wound them back.
Yeah.
I'm just having a look here. I just want to say it has been tried around the world across everywhere, and it was either ditched or wound back. The admin burden has effectively, for the most part, been resolved with how they plan to do it here. But what we're going to do, we're going to get into it, and we're going to get into the calculation of how they do it right now. You're listening to Money, 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 or as the regulars like to call us, M3. Everything discussed on the podcast is general advice only, which I'm licensed to give, and details can be found in the show notes. My name's Glen James, former financial advisor, now podcaster. I host this show and a show called Retire Right. I've also got a book called The Quick Start Guide to Investing, which you can check out wherever good books are sold, or there's a link in the show notes. Otherwise, thanks so much for listening today. Now on with the show.
Coming from the land, Glenn?
Yep.
There's a lot of farmers in particular that are not happy with this tax, because essentially that's where they've been shelving a lot of their funds over the journey to fund the next generation, as anyone have, not just farmers, but it's been in my world because I grew up there.
You don't have to tell us your own family situation, but a farm near your area, what would the standard size of that farm be in terms of hectares?
Yeah, so when I was growing up, I think maybe a 1,000 to 2,000 acre property would be considered normal.
Yeah.
I think now it's 10 to 15,000.
Okay. And what would a farm be worth of that size?
Yeah, so I think I don't know exact size depending on the type of soil and the growth and yield out of that soil, but I think anywhere from sort of 5,000 to 7,000 an acre is about standard in the area at the minute. And that varies across the country, of course.
Right. Well, have you got a calculator on you? Okay. There's
a lot of zeros.
Yeah.
So when you look at, say, the average of, let's take a 10,000 acre property. But when I suppose where I got to with how I got to this conversation with other people and how I knew this stuff was because to get into farming now as a junior is almost impossible. Like 10,000 by...
Unless you want to be an employee on a farm.
Yeah, you can be an employee till the cows come home, pardon the pun, but...
I won't.
Yeah, so 50 million is a standard 10,000 acre property.
And do you think many farmers actually own that asset and property within their self-managed super fund? No,
I wouldn't have thought, but a lot of the proceeds would go there as a security against their future because of the volatility of farming.
Yeah, but the proceeds into super, they're still abiding by the caps anyway.
That's right.
So it's almost, unless the self-managed super fund owns the farm, and we'll swing back and talk about that at the end because I've got a slide that mentions farm.
Yeah, and I think I haven't really been in total touch with it in the last 10 or 15 years on the ground, but I think a lot of farms now potentially have been purchased in self-managed super funds of late.
Yep, 100%. So if we now go and look at a simplified way that the calculation works, and if you are on YouTube, you can just pause this, or if you are listening in the car and you want to see it, you can watch it on YouTube as well. We might even put the YouTube link in the Spotify and Apple show notes. So we first have to calculate the super earnings, and that means we need to adjust the total superannuation balance. And you basically do that by looking at the previous year's balance plus adding back any withdrawals. So if you've taken money out to hide $1 million before the end of the year, they'll just catch that. And then we take off any contributions that have gone in from your employer that year, the net amount, and we'll get to that because then they don't want to tax the new capital that's going in because it hasn't grown yet, okay? No. So we then work out the calculation here. I'll read it for people. The total superannuation balance, and there's a slide next with the numbers. Take away the 3 million, which is the threshold, divided by the total super balance, the adjusted one, gives you the super earnings. Then we take the super earnings times the portion over the $3 million, and then you get taxed on the 15% on the taxable earnings, noting that unrealized gains are taxed. Now, the next slide here's a really practical example, and I'm just so sorry if I'll explain this the best that I can if you are listening, but that's why I had Josh and the team help me put this slide deck together. So in this example, we've assumed on the 30th of June, 2025, there's a $4 million super balance. Then fast forward on the 30th of June 2026, it's 4.5 million. The contributions for the year are 27,500,
which is our cap.
Yep, which is the concessional cap. Now let's look at the adjusted total superannuation balance. 4.5 million minus. So we have to get the current balance minus the net contributions, so 27,500 divided times 85%, which nets off the 15% tax, gives us the adjusted amount. Then we look at the earnings, so that is the 4,476,000 minus the balance last year. So we've worked out the increase.
Yep.
So that gets us to, and this is where it actually starts to matter, $476,625,000.
Yep.
Now we know that that amount is 33.33% over the threshold. Does that make sense?
Yeah. So the threshold is 3 mil, and we're saying that the actual balance now is 4.5 million. So you're 1.5 over the threshold.
Yep. So then what we do, the difference that I talked about, and this is why it's just going to make it so much easier to be looking at this, we look at the $476,000 times 33.33%, which is the amount over the threshold, gives us tax of the portion to be taxed, $158,000, equals times 15%. So the extra tax is $23,831. So if you step back and if someone did have $4.5 million in super and they started the financial year with $4 million, there's an extra $23,000 in tax. What's the problem?
Well, for who?
Well, yeah,
I'm looking
like
at,
not a lot of money, and that's why.
No, I'm looking at this saying
it's confusing.
Hang on a minute, $40 billion over 10 years, and one super fund who's 1.5 mil over the cap, we're only taxing them 23 grand. First of all, what are they worried about?
No. So
am I getting this wrong?
They're 2 million over the cap. So we have to see there at the top where it says 2025. June 2025 was 4 million.
Yeah.
So the 3 million is the cap, right?
Yeah.
But this is just in this financial year because it looks back from it kind of steps up each year.
Yeah. But the total balance is 4.5, yeah?
Yes.
So we're 1.5 over.
Yes, yes.
So 1.5 mil, when we extract that out with your percentage and deductions and everything else, means that I owe, if I had that, I owe 23,831 to the tax office.
Yes.
Right. I'm looking at that saying, well, if I've got 4.5 mil in my super, 23 is not really going to affect me.
Yeah.
But I also look at the government says 40 billion over 10 years.
Yeah.
The other
so there's 4 billion a year.
The other 80,000 Australians that this is affecting,
oh, mate,
they must have some super balances.
Some big super balances.
Yeah.
Vince, he always craps on to say that I think Australia's biggest super fund balance is like 500 million.
Wow. So I'm happy to tax them. Bugger it.
But this is the thing, like we're talking about 0.5% of the population.
Yes.
If you have that much wealth in super, I can guarantee something. Guess what's outside? There's probably a shat ton more. However, this is where I trip over It's the unrealized gains. I'm a capitalist like the next person, but there is a reason that it had to be that way. So
let's expand on that.
So we'll just go to the next slide, John. I don't want to camp here because it's just actually too confusing. But if you're on YouTube, this is an example where someone had $9 million and the next year they had $8 million and they withdrew 150 grand. There was an adjusted amount. So basically there was no Division 296 earning this year, but 850K carried forward. Okay.
Yep.
So, I don't want to go into that. Yeah.
Like in the normal tax system with companies, for example, you can carry the loss forward to put it against the future gain.
Yeah.
Right.
So, in the weeds, there's just a couple of comments here that are important. So, the adjusted TSB, the total super balance, it's the end balance plus withdrawals. Remember, they're adding back. So if you took out some money before the end of the financial year to hide money from the tax, they're going to add that back, less the contributions that you've put in. Mm-hmm. Now, withdrawals do include pension payments or benefit payments if you have a spousal split, so you want to move some money to your spouse. Mm-hmm. The first home super saver scheme, that is not treated as a withdrawal. Yeah. I would say if you have over $3 million and you're a first home buyer using the first home super saver scheme, probably not your problem. But that is not included as a withdrawal. They've excluded any fraud or dishonesty stuff, unclaimed super. So the contributions, so this is money coming in, death benefits, remediation payments, foreign fund transfers. It's carved out LRBAs, excluded only for the 296 purpose. So, and again, I don't want to get too much in the weeds here because there's probably none of our listeners who this impacts right now today. We can talk about the future. Could be mum and dad, though. Could be mum and dad. And just as a sidebar, on next week, Martin McGrath from our Retire Right podcast is coming in. We're going to do an episode for the Retire Right podcast. Martin will probably get a bit nerdier on the defined benefit payment. So this is just a brief overview for this audience.
Yeah. Okay.
So basically the LRBA, that is the borrowing within super. So they carve out that, but it really, if you've got over 3 million in super, there's probably not that many that would, I don't know. It's just, that's why I called this bit in the weeds.
Yep.
Next slide. I don't want to touch on it, but in terms of this defined benefit, so you might have a defined benefit pension. These are different beasts. Most of our listeners on the Money podcast probably won't have this unless they're a government employee or a little bit older or have got an old scheme. Look, there's some issues there. I read an article this week in the AFR about some potential double taxation. So again, this legislation could be amended and tweaked before it's put to bed, but this is why we just high level, this is what's happening. Current exemptions, High Court justices pre-1 July 2025 and constitutionally protected state officers, John, are exempt. Now that can mean governors, it can mean politicians, long-serving public servants. So that's an issue, a thing to note.
Yeah, that is an interesting exemption.
Well, this is the problem because a lot of these polys, they've got these defined benefits. And that's what I mean. I don't want to get into the weeds of that in this one. I will ask Martin McGrath next week when we record this for Retire Right to get into the weeds a little bit more on the defined benefit stuff. So there's other...
So basically what you're saying potentially is that a lot of our politicians that have got that structure are exempt from this.
Potentially, yeah. Yeah. But if you're writing the law, wouldn't you write it to your benefit?
This is interesting.
Yeah.
Go on.
Yeah. As you were, my child. So if you're a temporary resident, you can apply for a refund when you leave. So that's interesting. Now, the payment thing, look, you've got a couple of months, up to 84 days to pay after assessment and 60 days to release from your super fund. A lot of people, and we will read some comments in the Facebook group a little bit later, a lot of people were saying, well, if I've got this farm and it is worth $5 million and it's over and I owe $100,000 in tax, or insert your number here, and I don't have $100,000 liquidity in the super fund, I'm royally effed. They will let you pay this from your own bank account. So, you know, John, the division 293, if you own over $250,000 a year, you pay an extra 15% contributions tax. You probably get yours every year.
No, haven't qualified yet.
Oh, come off it. I want to know what you're doing over there. I elect to pay mine from my bank account. So the extra tax for contribution tax, you can pay it from your super fund or from your bank account.
And
so that's the same with the Div 296.
Okay, so it's a financial advisor sort of question when you're chatting with them to say, what's going to be better for me?
Well, at the end of the day, you owe X amount tax from super, be it from the Div 293, I think it is, or the Div in this situation 296.
Yeah.
You owe us X amount. You can pay it from the kitty in the super fund or your kitty in your bank account. We don't care as long as the ATO gets their money.
The bank account's doing nothing for you, or well, it could be offsetting
mortgage
funds.
For me, and this is situation dependent, I'm like, I want to keep as much money in super to get to this $3 million faster so I can pay more tax. But and this is why we have to yes, I totally agree with the outrage about the unrealized gains being taxed. Yes, amen. The indexation, it hasn't been proposed. Absolutely. I can agree and be outraged of those two things. I forgot my point, but the point was this is not going to impact that many people.
No.
And
But why do they have to tax unrealised gains again?
We'll get to that right after this.
If you're after personal financial advice, don't get it from a podcast. But if you want guidance tailored to your situation, head to moneypodcast.com.au and click Get Help. We'll connect you with one of our trusted professionals, financial advisors and mortgage brokers, who work with people right across Australia. No matter where you are, they can help. Now, before we get back to the show, a quick reminder to protect your financial life. That means having income protection sorted. It means having death cover if there's any debt or dependents relying on you. It means getting your personal insurance in order. Most people insure their car, they insure their house, but what about themselves? Sky Wealth, who support this podcast, are specialist financial advisors who can help you get the right cover in place. Their advice is often more comprehensive and better value than going direct through your super. Book a complimentary 15-minute chat at sky.com.au. That's skye.com.au. And they'll point you in the right direction.
Okay, we're back. I'm about to tell John the unrealised gains thing, but if we do step back a little bit further, yes, there is more tax at 30% to be paid for those who have account balances over $3 million, right? But where I'm from, that's still less than the highest marginal tax rate out of super.
Yep, 30. So it's company tax.
Well,
equivalent.
Yeah. It depends how big your company is, but the thing is it's less than 49%. Call it 50%. It does speak to if you are really wanting to get into savage wealth creation, it's just now you might not start to pump that. It might be more beneficial for you to use a bucket company, an investment company, but you're not going to have the CGT discounts, but you're not really getting that much CGT help with this scheme anyway.
Yeah, so you're questioning yourself saying, well, do I keep pouring it into super, which is traditionally known as a tax haven and be taxed at 15, but now I get another 15, or can I put it somewhere else?
Yeah, and that's the thing. I saw some articles in the last fortnight where, you know, the investment bond people are coming out and going, well, this is why investment bonds are now good, because it's like, well, if you're going to pay the same amount of tax, wouldn't you want it flexible out of super and all this stuff? It's like, well, what about we get our balance to $3 million?
Yeah, and then worry about it.
Or do some actual projections to go, yeah, within the next couple of years, you will be at $3 million and plan that way.
And that's the thing. Like if you're sitting at, say, $2 million, for example, that's going to scoot up pretty quickly with a few good years, isn't it? Like,
Potentially.
Potentially. You need to be having these conversations.
Yeah. Or if you've got a self-managed super fund and you put $100,000 into a meme coin and goes to the moon.
Yeah.
But also, good on you. You've made heaps of money.
Yeah. In that example, you're like, well, I'm happy to pay my $23,000 or whatever it might be a year because that was more or less a one-off investment. But some of these, and going back to the farmers, okay, this has been generational building.
Yeah.
Now we're getting to this stage, and hang on a minute.
So the thing we need to understand, the tax, it's more about when we look at the year-on-year difference, it's carving out contributions and looking at the growth difference.
Yeah.
Be it from dividends, rent, or capital growth. Now, I do have a case study, but what I'll do before we do that, so it's a case study of someone starting their career at 24. The reason why it does capture, I believe the main reason that it does capture unrealized gains is because you look at the biggest super funds in Australia, Australian Super, ART, which, they've paid us to advertise on the podcast. Aware Super, they've paid us to advertise on the podcast. I'm just disclosing this stuff as we go. Host Plus, Hester, Cbus. So you look at all these big funds in Australia, the way that they're worked, it's a unitized fund. So you might have $200,000 in your super account and each unit might be worth $1.
Yep.
And we did another episode on Retire Right. Just look out for it, everyone. It's about wrap accounts because we had to really explain how the super world works and the benefits of a wrap account because it gets around this internally taxed unit price.
Right.
And you can literally save thousands and thousands of dollars a year in tax, but you just don't see it because it's in the unit price.
Right.
So if you need to take money out of your insert large retail super fund here, they have to factor in asset sales. They have to factor in income from those. So it's all to do with the super mechanisms that it's a unitized fund. So it's just easier to tax that unitized fund with an extra 30% all in one. Done.
Yeah, okay. So if that is the reason, and you got a seat at the table at the High Office, you've surely been told as to why the unrealised gains have...
Well, I did ask Katie Gallagher about it, and I think it was even on the budget podcast, the recording.
Yeah.
Like it was an on-the-record discussion, and she was like, yep, is what it is type thing, because I think on balance they've looked at the numbers and we've just talked about the numbers. It doesn't actually impact that many people.
No.
So while I'm not 100% categorically disagree, say this out loud, everyone. We are going to tax you on an asset that has grown on paper. What if it grew on paper that year, you got taxed on it, the next year it tanked, and then you sold it? Well, you've paid tax the year before on a gain that actually wasn't really there because it wasn't realised.
Yeah, but you're getting that back.
No, not if literally there was portfolio movement.
Okay.
But just keep to the fundamentals. Yes, out loud, we are taxing assets, the growth of assets on paper, the paper value before. Like if I said to you, oh, John, you bought an investment property for $500,000, it's now increased to $800,000. Oh, that's $300,000. You got to pay some tax on that. It's just outrageous.
No, it is.
But if we understand the super fund unitized units in a fund world, it's got to be factored in an easy way. And that's why I don't think they're going to come out the next week and say to everyone, all right, everyone, we're now taxing unrealized gains for your investment properties and shares.
Yeah.
look what happened when they wanted to try and tweak franking credits.
Yeah.
Ask Bill Shorten what happened.
Okay, so that was my next question.
Yeah.
So individual stocks, like assets that aren't in your large superannuation firms, don't apply. Is that what you're saying?
No, the principle still applies
Yeah.
in the super funds, but it's just like this big chisel. It's like the interest rate
Yeah.
lever. It's
Yeah.
like just this big blunt thing where it probably works most of the time.
Yeah,
but
okay.
there's going to be things where it's like, well, but that's all we've got.
This is not fair for me. So if in your example, the 500K property goes to 800, I'm paying unrealised gains on 300K. I then sell it next year for 700. Now what happens?
You don't get the tax back.
Can't see how that's right.
This is the problem. This is the exact problem. 100%
And
it's
that,
cooked.
like, that's about to be passed.
Yeah, for super balances over 3 million.
Yeah, but
But you've got to, but yeah.
how can you pay a gain unrealised and then not be able to offset the loss if there was one on the gain that you've already paid? Like, that doesn't make sense to me.
Yeah, but this is why it's pretty cooked, but it's all designed around the unit price I believe anyway.
Well, there you go.
Or
Right.
or
So-
look at it the other way. We've got 80,000 Aussies
Yeah.
with tens and tens of millions, billions and billions and billions. You're getting a little bit yippy, John. In super,
Yeah.
they're kind of like, oh, stuff that. Who cares? We can tax them and they can pay with money outside super. Who cares?
Yeah, because they've got enough to go around. That's what we're saying.
Yeah.
And there's a
And-
portion of that I'm actually okay with, right?
Yeah, exactly. Like if you step back, superannuation, we don't want it to be just a tax haven for the rich.
No.
And by rich, I'm talking you got a net worth of over $200 million.
Yeah, the 0.5.
Yeah. Insert your definition of rich. There would be people who listen to this who say, oh, if you earn 300 grand a year, you're rich. Or if you've got a net worth of $3 million, you're rich. Sure. I'm talking in terms of this kind of discussion, I'm talking the rich, maybe $100 or $200 million net worth, big family offices. Yeah, come on. You're taking the piss a little bit,
Yeah.
but they're playing to the rules. So this is the circular logic, isn't it? It's like, yeah, it's cooked that we're taxing unrealised gains, but I don't think it's a huge issue, and I 100% would believe that any future government would not apply that to assets held outside of super. Unless, and this is so that's the biggest reason that's cooked.
So you think this is just the starting place for future?
Well, people will say it's a slippery slope. There's a slippery slope argument. I don't think it is. I hope it's not. But if you've got $3 million in super, you'll be okay.
We will, yeah.
But the principle, should we be taxing gains that are unrealised? Probably not. How else do you do it with unitised funds and,
But maybe
with
it is for unitised funds and nothing else.
Yeah.
I don't know.
Or it's just literally this is how we had to do the calculation, because as we've seen in the example, it's kind of a rolling year. So what was the balance on 30 June last year? What's this year? What's the difference? So it's not each year. If 1 year you had 3 million and 10 years later you had 10 million, they're not, in the 10 years later, they're not going, well, the difference between 3 and 10.
No.
They're doing the difference that financial
Annual.
year.
Yeah.
So
Yeah.
that's what I mean. Like it's cooked a little bit that we're taxing unrealised gains. I don't love that. Will it impact the average bear? Well, that's what we're going to talk about right now in our case study. So this case study here, I've just put it to start with. An individual started working in a career at age 24, earning $120,000, right? So I've just assumed for the first, 6 years of their life, adult life, they've left school, worked at a cafe, went to uni, and then all of a sudden, ta-da, overnight, they've got $120,000 income. And this is the thing with projections, that they're just useless after the first couple of years, because you just literally, it's really hard to do without financial planning software, because when we had financial planning software, you could literally look at the projection over the 10 years and you could put in a break in year 5 to 7 for parenting leave or maternity. So it's
adjusted along the way.
It's really hard. But just as a broad stroke of a scenario, the starting income, 120 grand, annual income growth. So this is no pay rise, just a 3% inflation on the salary each year. Okay, so it's a conservative projection. The super contribution rate is 12% because that's going up on the 1st of July. The tax on contributions are 15%, which means the net contribution rate is 10.2% of salary. And this is really hard to get these right because it hasn't even factored in if their income does grow to more than 250 and have to pay 30% on contributions and all that stuff. But the annual investment return, 8% growth. I've allowed for an internal tax on investment earnings of 15%, which is an effective net return in the super fund of 6.8%. I've included an annual super fee of 0.7% of the total super balance. And I've used an inflation rate for the investment returns of 3%.
So you would say that's standard across major superannuation companies?
Well, I think if you're targeting 8-9% return, it's probably pretty much, when you look at the long-term growth or high growth, it's probably around there. Anyone jump on any superannuation calculator and put these figures in, just copy what I've got on YouTube. You just have to consider the biggest thing people do when they do projections online, John, is one, they don't factor in tax, they don't factor in super fees, and they don't factor in inflation.
Yeah.
So based on this, someone earning 120 grand for the next 41 years without a break out of the workforce at age 65, how much in today's dollars would they have in their superannuation, do you think? Now, by today's dollars, I want you to think about someone that we know today who's 65 years old, who has worked for the last 41 years and has worked for that effective salary starting 41 years ago, 120 grand.
40 years, yeah. So you've got, so you're putting in 10% of salary.
Pretty much net, because we've had to take the 15% contribution tax off.
Yeah. Yeah. So I would say the average super balance ideally is around $500,000.
Yeah. So based on this scenario in today's dollars.
Dollars.
So based on this scenario, 937,000 approximately. So well under $3 million.
Yeah.
Okay. The nominal future dollars is around that $3 million. So that tells me if it didn't get indexed, most people still won't be impacted from it. This is not to say not indexing it. I think there should be a mechanism that it indexes. I do believe, and this was kind of what annoyed me about it. Like Jim Chalmers pretty much is on the record by saying future governments can increase it. Yeah. Absolutely, they can. But can't you just bake into this legislation every 5 years it increases in line with X, Y, Z? The concessional contributions are linked and non-concessional contributions are inflation linked.
Yeah.
So they look at it each year. Once it gets around over $2,500 threshold, that's when they'll go up as a rounding. So,
so even at 937 there.
Oh, you'll be fine.
Yeah, you will be, but probably only just, depending on how quickly you use it in retirement and how long you live for.
Well, let's assume if you owned your house and there's plenty of people that are retiring today
Yeah.
that own a house, and that's
Yeah.
another discussion. Like, it might be harder for people to own a house. If you did own your house by 65 and you had $1 million today, you're fine.
You will be fine. What's your definition of fine versus mine and everyone else's?
Well, I think what I'm saying is, to get to this, if you're earning $120,000 a year, take off a bit of tax, call it 80. That'd be about right?
It's about 26. It'd be about 85, 86, wouldn't
Yeah.
it?
Yeah. I'm a bit out of touch there, whatever that is.
Yeah.
So I guess what I'm saying is, net 80, if you paid mortgage repayments out of that or school fees or whatever, once you retire, more times than not, your income isn't increasing to 120 because you're not in the psychological vibe to be spending money. There's so many.
That's right.
So that's what I mean. Like, relative, you're probably going to be okay.
Yeah. Yeah.
But I want people to hear me loud and clear. Do I think there should be an indexed mechanism? Yeah, just bake it in. Do I think it's cooked that we're taxing unrealized gains? Absolutely. But step back 30,000 foot view, this is probably not a big deal.
Yeah, 80,000 Australians. Ned Kelly's come in to take from the rich to give to, don't know who yet, who's going to get it and who's going to pass it on. One other angle to look at this also, not an angle, but a thought for maybe a lot of Australians, especially living in maybe Sydney, is, well, okay, before this was preached, I can't afford a house to live in ever in Sydney, so I'm going to rent for the rest of my life. And you know what? I'm going to pump as much money into super as I can because that's a tax haven. Now they're sitting back saying, oh, hang on a minute, I better not put too much in, but I get taxed. Now, when you look at the numbers that you've given here today, they're not alarming figures, but yeah, the taxing on unrealised gains is another conversation.
It is cooked, absolutely. I don't believe, I can tell you right now, any government that would come out and say we're taxing unrealised gains further than what they're doing here, they would have to, that's political suicide.
Yeah.
But I think it is more of that unitised mechanism within super funds, because you've got to remember, John, one unit in a fund includes the tax of 15% taken out. That's why if you get, and this does go back to, have a listen to the Retire Right episode on wrap accounts. It's coming. Or if you're listening to this in July, it's already out. That's why if you look at pension phase, this could be the exact same investment in a Australian super growth fund accumulation, Australian super growth fund pension account, because they're different pots of money, the unitised numbers are different. The accumulation units have the 15% tax taken out. The pension units doesn't.
Right.
So that's why the returns look higher on the pension account, even though it's the exact same investment option.
Yeah.
Because it's in that unit price, there's no tax baked into the unit price.
Yeah, it's in the weeds. Yeah. Yeah, interesting. I think as listeners, we're naturally sitting back and thinking, well, how does it affect me? And how does it affect those closest to me? Or how does it affect my inheritance, or whatever it might be? That's generally what people are thinking. And it is a low percentage. So I'm surprised that it only affects that many Australians. And it just shows you we're probably a divided wealth nation, aren't we?
No. I wasn't listening because I was searching this.
Yes. You meant to say yes.
Yes. Yes. No. No, I was just opening the Facebook group because I'll read some comments in finishing because, John, you've got to hit the road. Yeah, Ali, thanks. This would be handy. Although I think it would affect future generations more than us. Well, that's the indexation thing. Sky says, won't impact us until the government see the benefit. Then they will reduce it to 2 million, 1 million, and then bring over to personal assets. That's the slippery slope argument. The Greens, prior to the election, there was chatter in the Senate that they wanted it to be $2 million, not $3 million. I don't think that's an issue now after the election.
That's a good point. There's no reason why it can't be in the future.
Yeah, Adam actually makes the point, just saw that Labor secured Senate seats that will definitely pass. It's going to happen, so make plans around it. They will index the $3 million the same way they index income tax rates eventually, says Tom. Okay, this is probably, and I know you do have to go, the planning around it, we don't go into full plan around it mode because the tax rate is still 30%.
Yeah.
We've got to remember, any assets in your own name are going to be taxed at 49% as the highest rate. However, this is the however, at least if it's in your own name, you won't get taxed on unrealized gains. But this is a bigger problem for those who are quite wealthy or are on track to be quite wealthy.
Extremely wealthy, or they've uncovered a whole heap of inheritance. Essentially, you're saying that it's affecting those that are on the highest tax rate. Is that a fair assessment?
Repeat the question, please.
It's affecting those who are on the highest tax rate.
Well, no, because you could be retired now and have $5 billion in super.
Yeah, but I suppose, you're retired now, but you've come from a high income. Generally you would say that.
Yeah.
So, yes, if you're arguing for the positives, you'd say, well, okay, yeah, you're right. It's come from, I'm used to paying 47, 49. Now I'm paying 30. It's better than my 47. Still not great.
Dev Raga, he's got the podcast, Dev Raga Personal Finance. It's one of our podcasts. He said the policy to ensure super is sustainable is a good one. I don't particularly like the argument. It probably won't affect the majority of Australians. Well, it doesn't, Dev, even though if you don't like that argument. Hi, Dev. Call me. Which is the way it's being sold to the general public. He says that argument doesn't matter. He says out of principle, if they tax unrealized gains in super, they should tax it everywhere else. And out of principle, taxing aspiration is a poor strategy. I don't think they're taxing aspiration. If you rock up tomorrow with $3 million or more in your super, you have arrived. And I think it is the unrealized thing goes back to the actual way, it's easy way to be calculated. It's probably cheaper to just do it that way than getting your accountant in your self-managed super fund to crunch it manually every year.
Is it cheaper, or they just know there's a lot of assets that are outside of
he says the cap
funds?
Should be indexed like everything else. There should be no exemptions like judges. The government introduced the super system to ensure people don't rely on the aged pension, whilst at the same time they're trying to kill aspiration and prevent people from living a life using their superannuation system. It's a paradox and hypocritical. I also don't like unlimited negative gearing. And then he went on. Look, I don't know. It's a very, and I pretty much said in the Facebook group, you start talking about this stuff, it leads to the philosophical capitalism, socialism, which leads to political, which leads to cesspool of people being rude and all this stuff. It sucks. I'm not losing sleep over it myself. I don't think you should lose sleep over it. If you want to lobby anyone, lobby your local member or your senator in your state. Anna said, how does it work with self-managed super fund and businesses, including farms owned in this structure? How do they pay the tax? Well, if there's no cash flow in super, they pay it with money outside of super. Far out. If there is no money outside super, they've got a bigger problem. I think Shay said, is it $3 million for a couple or individual? It's individual member balances. Jennifer said, I don't like taxing unrealized gains. Nicole, I'm keen to see if someone could do an analysis of when it would affect the ordinary worker. Well, based on...
It doesn't.
Well,
Not
you got to
yet.
look. There's a lot of people that would consider themselves ordinary workers that aren't on over $100,000 a year.
Well, it's probably more the super balance, not the ordinary worker. It's saying, well, if your super balance is anywhere from 500 to $1 million, it's not going to affect you too much, if at all.
Yeah, James said mainly concerned about this opening the door to taxing unrealised gains. Again, I can't see it, so I'm not personally losing sleep on that.
Blood on the street, no way.
Like stamp duty originally started small and a tax on the rich, now it smashes everyone. Yeah, and that's more of a problem with the property issue.
Down there, down
Amy
the track.
said, people are so up in arms over this one. Lol. Seems nuts that they wouldn't index this over time, but whatever. Super wasn't intended to be a tax haven. It was supposed to ensure Aussies are saving for retirement to be less of a burden on taxpayers, in my opinion. Interested to see your breakdown with Martin. Well, this is the breakdown with John. Doing Martin's one another time.
Sorry,
but look,
couldn't get Martin. But there was I read an article today about how long the pension's going to last for.
talk dirty to me.
Oh, I looked high level at it, didn't look into the weeds of it, but there's been talk for forever and a day that the pension issued by the government is going to run dry and say, look, we're out.
It's factored into the government intergenerational future report, and it's not going anywhere.
Yeah, well, mate, don't shoot the messenger.
I don't live in fear. I believe as a society,
Correct.
there will always be a safety net to look after those who need it. I genuinely believe that. And you look back at history, whatever government, some do it better, some than others, but it is baked into the long-term financial projections of the country. The question is, like I think it was Denmark recently are increasing and this is the problem with the language, the retirement age to age 70. But no, that's not the retirement age. That's the age that you are eligible for the government pension.
Yeah, well, the fact is from when Denmark and Sweden were doing all this, times have changed and we're now living 10, 20 years longer. So money needs to come from somewhere to factor in that.
Damon said, what's the argument against indexation? It seems like such a logical common sense tweak to the proposal that I'm surprised it's a sticking point at all. It's probably more of a budget thing. They've projected the next 10 years at $3 million done because they need to get the cash. I think it's more of a structural budget projection thing more than anything. Jim Chalmers will go down with this ship and this will happen. Don't worry about that. It's going to get through the Senate now. This is all going to happen. But from what I've learned today, if you do have more money than God and 3 or 4 or 5 or 6 million in your super, you know, the relative year-on-year tax of an extra 20 grand, well, thank you for your contribution to helping more Aussies.
Won't define you. Won't define you.
And it's annoying because I'm a capitalist like the rest of them, but
it'll affect you next year. You're in the 0.5%. You're in the 80,000 Australian.
I do not have $3 million or more in my super, John.
They could have just gone and said, right, the mining royalty tax is 2.5. We'll lift that to 5% and leave us all alone.
Yeah. You look at,
That's crazy.
I honestly, Australia is cooked with the amount of stuff we dig up here, and there's only a few people that make money off it. Gina and Twiggy, a few others.
At
like
the top, 2.5, change that to 5. I'd love to know how much extra revenue.
Yeah, but you've got to look. I saw something online the other day. It was a political dude. It's like every previous mining minister or resource minister, insert whatever state or federal.
Yeah.
Guess where they work now for a mining company?
Yeah.
Like it's just so cooked.
Well, you look at the exemptions in here.
Yeah.
Right?
Oh, whatever.
The
Knock yourself
judges
out.
and the
judges,
politicians.
whatever. But like, you even look at the gas reservation policy. Like we've got more gas here than on Earth, basically. And the governments of the day didn't say, well, no, everyone in Australia basically gets free gas for infinity, amen, and we just sell the rest.
Other way around.
Like why is Australia paying global spot prices for gas where it's coming from here.
Yeah, we're the resource.
Like, this is just so cooked. And I was thinking about it last night, actually, in the shower. Australia's such a small population with all these resources. It's almost like just over time, like you zoom out, it basically government, policy, everything, basically a bit of a boys' club.
Oh, it absolutely is. And that's what I said before when you weren't listening. It's a divided country of wealth. The top are taking it all. And we're privatising everything. Like, I went from here to, from Central Coast to Sydney on Sunday and went through 3 set of tolls.
Oh, it's $50 return trip. Probably
That's
more.
Just outrageous. We should not having to do that in 2025. But anyway.
You've heard it here second, everyone. My name's Glen James. Hey, if you found this useful, thank you. Please feel free to give us a like and subscribe on YouTube. Please feel free. Would have really appreciated a 5-star rating or review on Spotify or Apple. Share it with a friend. Do we get everything right? Nope. Do we try? Yeah, pretty much. Try and get it right. But if you don't agree with our comments, all good. Still love you. My name is Glen James, and you are?
John Pidgeon.
See ya.
Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs. Simo Interactive Pty Ltd, the publisher of this podcast, and Glen James are authorised representatives of Money Sherpa Pty Ltd, which holds financial services license 451289. Opinions or comments from any guests on the podcast are theirs and not those of the host or the publisher or their respective license holders.